Let's bring in BMO Private Wealth Chief Market Strategist Carol Schleif and Regions Wealth Management CIO Alan McKnight. Guys, welcome. Alan, you didn't get a whole lot of new information here, but at least the Fed, in its initial decision on a quarter point, was mostly aligned. I mean, they've had more dissent in the past. What does that say about the future?
I think the most positive thing for us was there wasn't this major surprise. We had so much agita and angst going into this where it was going to be this big major deal and all these things were going to happen, when in fact it was pretty quiet and pretty calm. And so as we look out over the future meetings this year, our hope is that we'll have similar type of situations where it's pretty well communicated, the market doesn't react in a visceral way, and we're able to actually get through the end of the year with the FOMC almost removed from being the major discussion point. Let's get back to earnings. Let's get back to what are companies doing, what are they seeing at the tip of the spear, rather than expending so much energy on trying to prognosticate what the Fed is going to do.
Carol, with the market fully valued now and the Fed out of the way, is it all on earnings to justify that? Is there upside?
Well, first off, thanks for having me on. Second off, earnings and fundamentals have definitely undergirded the way the market's behaved all year. We don't necessarily think the Fed and discussions around the Fed are off the table. And I think one of the reasons you saw the volatility in the market today is initially a lot of investors came out and said, oh, good, it looks like we're opening the door for more cuts. They were hoping for more clarity, much like what we got out of Jackson Hole. And we're left with more of a dotted line sort of decision tree instead of a straight, solid line forward. And so I think the Fed will be part of the discussion in terms of what does it say about the broader economy, but also clearly employment will be there. Luckily, we're coming into an earnings season, and as your prior commentator was talking about, there's a lot of strength coming into this quarter and a lot of good solid fundamentals, but that keeping people employed and keeping those earnings rolling is going to be really imperative to get us through the fourth quarter.
Alan, what is the role of fixed income in portfolios now? It's been disconnected from tradition lately, but do you see it still having a role there?
We think it has a powerful role now, specifically because it now actually generates income again. There was a time not that long ago when you were actually almost paying someone to hold your money for you. But now you're actually generating income. It's a ballast in a portfolio. We always think of it as this idea that you can't control the wind, but you can control your sails in a portfolio. And fixed income allows you to do that. So, yes, spreads are pretty tight on investment-grade corporate bonds. And, yes, we've actually already seen a pretty nice run this year. But we think they can still do pretty well over the course of this year and into next year, assuming no major or challenging time periods from an economic perspective. And that's our base case.
Carol, what sectors do you like?
We continue to like technology, communication services, but underneath that, the industrials, especially as you're building out the infrastructure to support what's going on in the AI and data center build, but also more bringing back the manufacturing. There's a lot of really pro-business attributes to the One Big Beautiful Bill that have pulled some of those projects that were shelved earlier in the year and put them back in. And so there's a lot to be said for industrials and manufacturing. Even though the numbers coming through economically have been a little tepid, we expect to see some pickups going into the back half of the year.
Alan, how about you? What do you like? Offense, defense?
We still like some offense, and we like to balance it out. So we like comm services similarly. We think that they're generating significant cash flows. I think earnings are there. I have to say, first time in my career, I'm actually talking about utilities. My wife teases me. She said, you've never talked about this in 23 years, and suddenly I am. But
your wife teases you about utilities?
Oh, yeah. Obviously, I talk way too much about this sort of thing. I'm boring the whole family with it. But the reality is, now it's a growth story. And so we're excited about things like that. We're excited about mid-cap companies that can actually generate more growth while having lower valuations. And we think the market can continue to do well over the course of the year.
Carol, are small caps going to finally make a sustained run at it?
It's more difficult, and the question is still there for small caps. They definitely have started a run recently, mostly in anticipation of a Fed cutting cycle, not just a one and pause sort of thing. But the biggest challenge that the smaller and the mid caps have right now is the fact that they do have higher leverage, but more specifically are more impacted potentially by tariffs because they have less negotiating room, if you will, to try to negotiate some of the way around. And so it's it's definitely worthy of active management. It might be tough for them to sustain long-term going into next year.
And Alan, what does that move we saw in Oracle tell us about the continued stamina of some of the bigger names?
I have to be honest with you, we were a little concerned when you see a stock rip like that. Is the company worth 40% more in one day? Some could argue maybe no, but the idea that behind that, with AI, the power generation component of it, and really just this productivity boon, because as we see, services costs are coming down. We heard that from the Fed today. We've seen that in some of the inflation data. So we need to continue to try to be more productive, deliver more efficiently, and we think companies like Oracle and some in the tech field are really going to be able to deliver on that.